Good morning, everybody. My name is TC. I'm Director of Business Development at Sentio Capital. On behalf of Sentio, I would like to welcome everybody to this webinar today. And thank you very much for your time in attending. I think there are still a few people who are dialing in, but in the meantime, just to reiterate, there have been some regulatory changes within the investment space announced earlier this year, increasing the offshore allowance to 45% from originally 30% plus the 10% which was allowed for Africa. Those changes can present opportunities, but certainly can pose substantial risks as well. So therefore, I'm extremely pleased to introduce Rayhaan Joosub, who is one of the co-founders at Sentio. He is also the head of portfolio manager and head of multi-asset. And he and his team have done substantial research and analysis into the risks and opportunities presented by this regulatory change. This presentation should last about 45 minutes or so, which then can be followed on with some Q&A. We aim to finish quite punctual at 11 o'clock. So if your questions might have not been answered at that time, we're happy to engage with you after that by email, etc. With that, I would like to hand over to Ray. Thank you.
Thank you, TC, and thank you everyone for joining, and welcome to our 8th edition of Thinking with Sentio, focused on global investing. I just want to quickly get a check from TC and the guys. Can you guys see my presentation and can you hear me fine? Is everything okay?
No, at the moment we can see you, not the presentation.
Oh, okay. Let me try and share again. It says I'm sharing. I'm going to stop share and try again. Can I check? Can you check now? Is it sharing?
No, it was there before.
I can see. I mean, I can see the presentation, right?
Can you see? Perfect. Okay, so I'm going to go ahead with the presentation. But again, thanks everyone for joining us. So quickly, just in terms of agenda, what are we going to discuss today? I'm going to start off with the introduction, with just some context in terms of the basis of our analysis, by which we come to some of the conclusions as to what is optimal from a global investing perspective and our approach around global as well. I'll speak about the benefits and risks of global investing. And then talk about the optimal allocation. What's the optimal allocation, depending on what you're trying to achieve for your specific client base. And then finally, I'll end off with some useful tips and how to execute a global strategy and some of the thinking around what Sentio does from a global allocation perspective. It is a fairly involved presentation. I'm going to go through some of the details fairly quickly, so please ask questions. I'll leave some time at the end of the presentation to ask some of the questions, and so please don't be shy. Ask anything to get some more clarity. So just in terms of some of the assumptions that we go through in terms of the analysis in determining what's the optimal global allocation. I mean, the most important thing that we start off with is that we're making the assumption that we're investing for South African investors that are planning to invest in South Africa or planning to retire in South Africa, which ultimately means that the liability profile, which means what we're trying to achieve for our clients, the objective of our investment strategy, is very much a rand-based investment strategy or rand-based liability profile. So CPI or South African inflation rates plus target returns above that is effectively our objective to actually achieve from the investment perspective. And why that's so important is that some of the analysis that you'll see and some of the conclusions that we draw could be different to some more kind of aggressive assumptions out there in the market, like just invest maximum offshore and don't bring any assets back to South Africa. So we do come to some slightly different conclusions to that kind of narrative that exists in the market out there, especially in the retail space. And that a lot of that differences lies around the fact that our assumptions might be different to some participants who maybe have SA investors who are planning to retire offshore. So I want to put that out on the table. And then second, there's this assumption that global assets are the panacea and there is only opportunities and returns, but there aren't any risks. But we're going to dispel that notion completely upfront. Global investing does give you very attractive opportunities, but at the same time, there's clear risk issues that you need to take account of. And our Sentio philosophy is all around risk-adjusted returns. So taking the best from a return perspective, but making sure at the other end of the equation, you're managing those risks. We are a risk-adjusted return kind of manager. We're all about trying to manage risks as well. So it's a combination of the two. Investing is two sides of the same coin. You can't just focus on the positive side. You can't just focus on the return side. You've got to look at the risks and manage those risks as well. So you'll see the thread in the presentation is all around what are the benefits and what are the risks as well. So let's dive into the presentation quickly. I mean, let's sort of summarize some of the key aspects. Let's look at all of the benefits and all of the risks. And the focus here is global investing. So the chart that you're looking at up front is a long-term history of South African asset classes and global asset classes. So from a global equity perspective, we're looking at the MSCI Developed Market Index. Global bonds, we're looking at global treasuries. So no credit, global government bonds effectively, all measured in rands. Global equity and global bonds. SA equity, you're looking at the all share index going back historically there, and the data set is 1976 to 2022. So almost a 50-year period that you're looking at there. The SA property index is the full current SA property index prior to 2000 and prior to the 1990s. We're using the JSE property unit trust index and the property loan stock index effectively to construct a composite spliced property index over that whole investment period. And for SA bonds, we're looking at just SA nominal bonds, non-inflation linked bonds, going back historically to 1976. So they'll all be effectively since 1976. Immediately, you can see all of your returns, your cumulative returns at the top in terms of the charts. At the table at the bottom is a nice summary in terms of the different return stats and risk stats that we look at. So you look at your Sharpe ratio, which is effectively a risk-adjusted return. So looking at your nominal return adjusted for the volatility of the underlying assets. So it's a nice risk-adjusted return, and we sorted all of those asset classes on a risk-adjusted return basis. So SA bonds comes out the best from a risk-adjusted return perspective, and global bonds comes out with the worst risk-adjusted return. The second table, which I'm highlighting now, is the nominal annualized return over that full investment period. So 12.03% example for nominal bonds. You can see SA equity was the highest at 17.99% compound per annum over that full almost 50-year investment period. Then you're looking at your real returns, so adjusted for SA inflation, which is 8.79% over that full investment period. And then you're looking at your annualized volatility, so just the variability or the standard deviation of those returns on an annual basis. Then you're looking at your VAR monthly 95. What does that all mean? Very simple. You're 95% confident that the worst monthly return won't be worse than what you've got there. So you're 95% confident you won't lose more than 2.92% on SA nominal bonds, 6.01% on global equity, 8.4% on SA equity. And then your final one is your maximum drawdown. So from the top of that asset class to the bottom of that asset class, what was that loss, maximum loss that you've experienced historically over that investment period? So you can see the most risky has been property, 62% from a drawdown perspective, then global equity at 50.66%, and the least risky is SA nominal bonds at 22.26% from top to bottom effectively. So what are some of the conclusions that we draw from this analysis effectively? Very simple. I mean, you can see SA equity outperformed, gave you the highest nominal return, but it came at very high risk and high volatility and high drawdowns. SA nominal bonds was the lowest returns from a nominal perspective, but from a risk-adjusted perspective, if you take into account the low volatility of nominal bonds, it actually gave you the best risk-adjusted return. Global equity gave you excellent returns from a risk-adjusted perspective, but we had those very high drawdowns, maybe 50% drawdowns, and I'll talk about that a little bit more in the upcoming slides. Global bonds gave you the worst risk-adjusted returns, but in coming slides, you'll see that it's not just return, it's not risk. What about diversification? That's the third element of investing: returns, risk, diversification. You'll see some slides coming up where I talk about the diversification benefits of global bonds. And then SA property did reasonably well from a return perspective, but had terribly high drawdowns, as you saw during the COVID period. And we'll talk about that a little bit more as well. But I mean, the key lesson here that we're drawing from the analysis over a longer term investment period, no asset class is perfect. And that's why from an investment perspective, we all invested in balanced funds in the end. Diversification is key. You need to just understand how do you mix these assets together. And a lot of the presentation now going forward is all around how do we mix those asset classes going forward. So I mentioned global bonds. You know, you saw global bonds gave you a low risk adjusted return, but let's bring diversification into account. So the graph that you're looking at right now is effectively taking SA equity and trying to understand how the different asset classes relate to SA equity effectively. So what is the percentage of returns from SA equity explained by other asset classes? And that's what you've got on the y-axis that I'm pointing right now. So it goes all the way from 0% all the way up to 40%. So at 40%, 40% of the risk or returns of SA equities explained by that asset class. And we're looking at rolling 10-year windows here to sort of get a nice sample that you're not just looking at random noise over one year investment period. So what you can see immediately at the bottom there, which is the red line, and you can see the highlighted portion over there, that global bonds explains the least relative to other asset classes of SA equity, which means global bonds is the best diversifier of SA equity risk effectively. So global bonds, remember again, previously we saw that they gave you a decent return, very high volatility, so risk-adjusted returns weren't so great. But from a diversification perspective, they add wonderful diversification benefits to an SA equity portfolio, as well as an SA fixed income portfolio. We'll see in a little bit more analysis as well. So global bonds, the best diversifier. Then second up, you can see the gray line, SA bonds, pretty good diversifier of SA equity risk that has deteriorated to some extent since 2018, 2019. So SA bonds have become a little bit more correlated with SA equity. And I was explaining more of SA equity risk, largely because of the fact that we've become we've lost our investment grade status over that period, given our elevated political risk and the elevated levels of debt that the SA government's currently got relative to the history. But still, SA bonds does a very reasonable job at diversifying SA equity risk. Next one is the blue line in terms of diversification is property. You can see property explained very little of SA equity risk right up until COVID. And then all of a sudden that shot up dramatically to around 25-30%. And you know, the big question now is whether that's going to normalize going forward. Our take is that COVID was a pretty unique risk event, and that's going to normalize going forward, and property is going to become a better diversifier going forward. But for now, you know, you can see property hasn't been the best diversifier, especially in the last 2-3 years, effectively. Global equity is got the most correlation with SA equity, average explaining about 35% to as low as about 20% of SA equity risk. But if you actually think about it, it's actually not that high a number. You know, you would have thought that that number would be close to 50-60%. So it's interesting, global equity does give you good diversification to an SA equity portfolio. But importantly, and we're going to focus a little bit more and drill a little bit more into global equity. Remember, this is your MSCI index. We're going to drill down to specific styles in the MSCI index and specific sectors and see which styles and which sectors give you the best diversification to SA equity going a bit more later in the presentation as well. Just looking at diversification is one element. Looking at capital protection is another element. So what we've done here in the analysis is we've just split the investment period over that 1976 to 2022, split the Aussie periods into rising periods and falling periods effectively. So in blue, you've got your rising periods, and that's your average return over all rising periods. And in red, that's your average return over all falling periods. So you can see when the Aussie rises on average, that full period rises about 35%. And when it falls, the average falls at just slightly more than 40% effectively. And then we classified all the other asset classes in that same buckets effectively. So when Aussie is rising, when Aussie is falling, and let's see how those other asset classes look. So you can see SA property pretty much correlates on rising and falling periods very closely to that of Aussie, global equity as well. But you can see the diversification benefits you get from global cash and global bonds. They rise together, but when Aussie falls and other asset classes fall together with that, global cash and global bonds actually rises during that period. And a lot of that is related to the weak currency benefits that you get from global bonds and global cash. So the dollar values are fairly preserved. Sometimes the dollar values actually even rise when equity markets fall. especially SA equity. But when you translate that into Rand, the Rand typically crashes during those periods. So there's an inverse correlation between the currency and SA equity and risk assets, because our currency is a risk on asset. So what you get is the double benefits from global cash and global bonds. Dollar values either rising or staying flat, but you get the currency benefits as well on top of that. So you know, they're wonderful capital protectors and diversifiers at the right time. And diversification is something you want, in particularly when markets are falling effectively. SA bonds doesn't do badly again here from a capital protection perspective. You can see not as good as global cash and global bonds, but reasonably well as well. So you can see the importance of not just about global equity, it's about global bonds and global cash as well in your multi-asset portfolios. They give you the diversification benefits, and they protect your capital in falling markets as well. Now I'm just going to look at global equity and global and domestic equity. So we're drilling now a little bit more deeper into the different asset classes and extracting a little bit more information out of it. So the analysis is going from high level to a little bit more granular, and then we'll put this all together in terms of what our asset strategy is and how we execute on that in later slides. So what we've done here, you know, departing away from a very, very long-term analysis, now looking at 45, 46 years of data. Now we're looking at rolling 3-year periods, because from an investment perspective, you know, in the long run, you know, Kane said it, we all did in the long run. You know, you've got to look at intermediate investment periods to actually make relevant decisions as well. And 3 years is a pretty long period by which, you know, clients judge asset managers like ourselves, and you judged as well from a service provider to your clients as well. 3 years is a fairly long period. So you're looking at now rolling 3-year periods, and what we're looking at on the chart there is rolling 3-year investment periods of global equity versus domestic equity. So, I mean, immediately you can see the last 10 years, I mean, the red line, which is global equity rolling 3-year returns, has been fairly comfortably above domestic equity for an extended period of time. So 10 years of global equity outperforming SA equity. And in our psyches and our investment thinking, the recent past becomes far more highly relevant than what's happened in the longer term past. But it's important to sort of look at the longer term past as well, and look at just that 10-year period before that, from 2000 all the way up to 2012, SA equity, and sometimes for really large kind of extents as well, outperformed global equity. I mean, you saw the GFC period where global equity underperformed. The commodity super cycle, which was the mid-2000s, really supported domestic equity over global equity. And you saw similar situations in the 1970s and 80s when you had again a commodity super cycle supported by high inflation and precious metals, in particular gold stocks, driving SA equity relative to global equity. So it's not true that domestic equity underperforms always relative to global equity. You saw that in the super long-term analysis, domestic equity did outperform global equity, but for those, you know, rolling 3-year periods, for a 10-year rolling period, domestic equity can outperform global equity as well. So it is important to understand that these investment cycles are going to repeat themselves in the future, and it is going to be very important for you to be able to allocate between domestic equity and global equity. More on that point coming up a little bit later. The other issue, what you can see interestingly, is that global equity tends to have bigger drawdowns than domestic equity. I mean, you saw that during this period that I'm highlighting now, which is the tech crash. It was compounded by the Rand strengthening over that period as well. And then the GFC as well. You know, during that period, you saw global equity on a rolling 3-year basis giving you negative returns, whereas domestic equity made enough returns during that the super cycle period that you know, the rolling 3-year return actually didn't dip into negative territory. So those commodity super cycles become very important for domestic equity, and you want to be in domestic equity during those super cycles, not only from a return perspective, but you make enough that it protects you during the down cycle as well. So we looked at returns. Let's look at rolling 3-year volatility, which is the risk element. What you can see interestingly is in the blue line, domestic equity used to be a very high risk in the 70s and 80s, because we were very much a commodity-centric country. The gold mining and the rest of the mining sectors were a large proportion of our all-share index during that period. And we were very risky during the emerging market crisis as well, which I'm pointing out right now, between 1998 and 2000 as well. But interestingly, since then, our equity risk has been on a downward decline. Sure, you get your up cycles during the GFC and what we've currently experienced recently as well. But you can see there's a clear trend in terms of the blue line of domestic equity risk converging towards global equity risk. So it's not true that SA equity is necessarily higher risk than global equity as well. And a lot of that is because of the diversification that you're getting from inward listings in South Africa over the last 15, 20-year period. So stocks like BTI, stocks like Anheuser-Busch, Naspers and Prosus growing large in the index, Richemont growing large in the index. So South Africa is becoming, the SA equity index is becoming more globalized, bringing the volatility and bringing the risk of the SA equity down. So that is an important element to also remember that SA equity is not necessarily always riskier than global equity. So, we throw back at some of the comments that global equity is lower risk than SA equity. It's not necessarily the case. Sometimes yes, sometimes not as well. And let's bring in this concept of diversification a little bit more. Similar analysis to the asset classes where we said SA equity. Let's see how much of SA equity is explained by the different asset classes. Now we're looking at global sectors, styles, specifically in this case, how much of the global style exposure is explained by explains SA equity risk. And we just looked at 3 styles: global value, MSCI value index, the MSCI growth index, and MSCI quality index. And what you can see clearly is that the quality index, again, that's a percentage explained on your y-axis, going all the way from 0% all the way up to 40%. You can see the red line at the bottom. Quality, global quality explains the least amount of SA equity returns and risk effectively. So global quality gives you the best diversification benefits to an SA equity portfolio. And then you can see next, it sort of swings around between growth and value. At the moment, growth is the next best diversifier at about 20%, and then value the least diversification you get from global value exposure. So what you want to do from a global, from an SA manager perspective, if you're managing an SA balance fund with global exposure, you want to have a little bit more towards bias towards global quality and to some extent global growth as well. And that's the exposure that gives you the best bang for buck or the best diversification benefits to an SA equity portfolio. If you look at it from a sectoral perspective, similar graph again, what's the percentage explained of SA equity from different global sectors, again, in MSCI sectors. You can see at the top, MSCI EM and mining, it gives you the least diversification because it's the most correlated, explains the most amount of SA equity risk, which makes a lot of sense because SA is an emerging market with very high commodity exposure, high mining exposure effectively. The best diversification benefits you get investing globally, the best bang for buck is from the staples sector, then technology, then on top of that, consumer discretionary, and to some extent, global financials as well. So if you want to use your global allocation to its best benefits for an SA equity investor, look at global quality and global growth to some extent, and global staples from a sectoral perspective, tech and consumer discretionary as well. And that's our approach at Sentio, and I'll bring that together again towards the end of the presentation. Let's look at the global fixed income space now. Let's compare global bonds to SA bonds like we did with the equity case. Very interesting, you can see global bonds, just as a reminder, over this full investment period outperformed SA bonds by about 1% per annum, 13% versus about 12 and a bit percent for SA nominal bonds. But interestingly, you can see periods when SA nominal bonds give you bad returns. Very often global bonds will actually do well. Again, during that period, global bonds did well in red related to SA bonds. So there's this diversification benefit. Remember, I mentioned global bonds versus SA equity, but also versus domestic bonds. Global bonds gives you wonderful diversification benefits relative to SA equity. The problem for global bonds comes in from a risk perspective. If you look at your rolling 3-year volatilities, global bonds consistently higher, especially over the last 20-25 years, more riskier than SA bonds. And a lot of that, most of it, 99% of that risk is coming from the currency risk effectively. In other words, when Rand strengthens, global bond volatility actually goes very high. Obviously, sometimes when the Rand weakens, you actually get the benefits, but the worrying periods is when the Rand strengthens. It takes away a lot of your benefits from global bonds. So global bonds, the issue around global bonds is managing that currency risk. So what we do at Sentio, and this is just an indication of a backtest of our custom designed Rand hedging strategy that we overlay our global bonds in our SA balance funds. How do we actually bring that drawdowns effectively is by managing that currency risk and hedging out the periods when the Rand strengthens. hedging for that period of rand strength, but at the same time, you still want to get the benefits for when the rand weakens. Remember the importance of the rand weakening during periods of SA equity risk going up and SA equity drawdowns. You want to get the benefits of that currency weakening. So how do you get the benefits of the currency weakening, but protecting for rand currency strength? We've designed a custom strategy that we feel works best for our investment approach within our balance funds. And what you can see there, the period that I'm highlighting, this was a period when global bonds did badly in dollars, but it was compounded by the rand strengthening. You can see with that currency strategy in the dotted line, you take all of that drawdown risk just purely by hedging the rand currency. Similarly, you saw that in 2011 and 12, when the rand strengthened and global bonds were doing poorly, you took all of that drawdown effectively by hedging your currency. And similarly, you saw that in 2018 and 2019, when global bonds did poorly again, when the Fed was hiking, and you took out that drawdown risk effectively by hedging out the currency effectively. But at the same time, all of those periods when you get the benefits of the weaker rand, you lose very, very little of those benefits. So if you just look at it from a risk-adjusted perspective, unhedged global bonds gives you over this 20-year period a negative Sharpe ratio, and you make that positive purely because you're bringing the volatility down 18.22% to 9.62%. So what you've done effectively is taking your global bonds and you've made them the same risk as your SA nominal bonds, and you've effectively improved the risk-adjusted return that you're getting from global bonds. And that's the key important element that you're trying to focus on in your global bond strategy effectively. So let's put us all together. What are the benefits of global equity? Clearly, in periods when SA equity returns are weak, and that typically coincides with weak commodity cycles, or SA going through a tough political patch, and we know South Africa is in a tough political situation at the moment, likely to persist. You want global equity for those kind of periods. So you want to have it from an equity return generation kind of perspective. But at the same time, global equity gives you very good diversification benefits, explaining only 30% on average of SA equity risk. But you can actually make that better by focusing on quality, by focusing on the right styles. You get increased diversification benefits and more bang for buck from your global equity exposure. Global bonds is the best risk diversifier for SA equity risk and SA nominal bond risk as well, and the best from a capital protection perspective when the proverbial hits the fan. That's when you have your fixed income, your global fixed income exposure. What are the negatives with global equity? We highlighted those drawdowns that you see post GFC. And during the tech crash as well. Global equity does have periods of bubbles that develop and bubbles that burst. Cheap money is a phenomenon that seems to help global equity a lot more than than SA equity. But when the cheap money gets withdrawn, or those bubble bursts for whatever reason during recessions, your drawdowns can be high in global equity. So the importance there of allocating carefully between global equity and domestic assets is very important and very crucial. So I'm mentioning this again. Asset allocation needs to be active in terms of domestic equity and global equity to manage for those global equity risks that you see. And global equity can have periods of underperformance, typically during commodity super cycles, and you want to benefit from that. As an asset allocator on behalf of your clients. Those returns can be substantial and an outperformance can be substantial. So don't underestimate the importance of active allocation between domestic equity and global equity. And then we mentioned the currency risk with global bonds. To some extent, that also exists with global equity, but it's more of a global bond or fixed income problem. And we mentioned the importance of having a currency hedging strategy to manage that effectively. So let's answer the question now. What is the optimal global allocation that you need to have in your portfolios? I'm running a little bit out of time, so I'll go a little bit more quicker through this. So what we've done is, over that full investment period, again from the early 70s to 2022, we took a infinite number, or almost an infinite number of portfolios. You can't do that. You'll carry on analyzing for forever. So you took about 100,000 portfolios. And compared, and all those portfolios at random weights effectively, depending on how much global equity, domestic equity, and the different asset classes, all adding up to 100. And we compared those portfolios then against different CPI targets over a rolling 3-year period. So CPI plus 0% to always CPI plus 9%. So defensive mandates on the left-hand side, more aggressive mandates on the right-hand side effectively. And then we compared those portfolios, those random portfolios, against all of those CPI targets. and just took the top 5%, so your best portfolios against each of those CPI targets, and then you took the average of those best effectively. So the top 5% and what's the average allocation, asset allocation for each of those different targets. So effectively what we're saying is, what is your best portfolios asset allocation to achieve different CPI targets? And what you can see on the left-hand side is when CPI targets are low, and on the top is your red bars basically is your global assets, and your black and blue bars is your domestic assets. So you can see there's a nice monotonic increase in global assets as you target higher returns, and you can see that on the right hand side, global assets move from about 22% if you're just trying to target CPI, all the way up to about 63% for very high CPI targets. Then you need a lot more global assets. But then also what you're also looking at, interestingly, is your split between global bonds and domestic bonds for low return targets. You need a lot more global bonds relative to global equity. And when you're trying to target higher returns, you need more global equity relative to global bonds. And it makes perfect sense. It's all about what you're trying to target from a return perspective, and what is your risk appetite. But I mean, ultimately over that full long period, you know, your target, your optimal allocation for global goes from about 20% all the way up to 60%. So quite a wide range in terms of what is optimal. So if you're a conservative client, your client's close to retirement, and your CPI plus targets are lower, you know, you want to have less global in the portfolio, closer to 20%. But if your clients are a lot younger, a lot more aggressive from a risk appetite perspective, they're targeting higher returns, you want to be closer to that 60% mark in global assets. Obviously, you can't go above 60%, 45% is the maximum allocation. But more important, this is an analysis over the full 50-year period. Let's look at that over intermediate investment periods, because like I mentioned, in the long run, we all did, you know, what is optimal over shorter investment periods. Okay, I see a question here. So what we mean is very simple. So remember those 100,000 portfolios relative to CPI. So say CPI plus 5% is your target return, and over that period, CPI plus 5% was a 13% return. So you look at all of the 100,000 portfolios that exceed that 13% return over the full investment period, and then you take the top 5% of those portfolios effectively, and you form an average out of that top 5%. So you're looking at your best portfolios that achieve that minimum hurdle of 13% return for CPI plus 5. And similarly for lower investment portfolios, the target return drops to say 8% for the CPI plus 0%. You know, you look at your top 5% of the portfolios that actually achieve that 8% return, and you take the average of that effectively. Does it make sense, Suniti? Okay, I'm just going to move on there. So, like I say, in the long run, we all did. Let's look at intermediate investment periods. Let's look at a rolling 3-year return, but over 20-year windows. So you look at 20-year asset class returns, and you're looking at them on a rolling 3-year kind of investment period, like we did previously. And let's look at how stable that asset allocation is. And what you can see on the left-hand side, how unstable that asset allocation is. You can see during periods, the 80s, the early 90s, culminating in the emerging market crisis that you saw, global assets was close to 60% effectively. And then when you went into a period where domestic assets did a lot better, especially domestic bonds in that big gray area in the early 2000s, that allocation shot up dramatically, and your total global allocation dropped dramatically. And you can see that on the right hand side, your total global assets, global equity, and global bonds over rolling 20-year periods for 3-year investment windows that can range up to 60% and can drop for extended periods down to 20% effectively. So again, I'm going to emphasize that point. Active asset allocation, very, very important to actually get right. Your optimal allocations, you know, over a long period might look a certain way, but over 20-year rolling periods, which is also a fairly long period, you know, can actually vary a hell of a lot. So the Sentio approach is very simple. Let's look at that average allocation of that full periods for that rolling 20-year windows. You come up with a 35% long-term average, and we chose 40% as our total global allocation for our strategic asset allocation, because we can hedge the global bonds in our portfolios from a currency risk perspective, bring their volatility down. We feel we can target slightly higher global allocation structurally. So we're going higher than the 35% to the 40% level, and we've set our benchmark, strategic benchmark, at 40% for our global assets, 25% global equity, and 15% global bonds. So obviously we've run the analysis, and that's where we come up with 40% effectively. So the numbers, I want to emphasize here again, the numbers are very volatile. The ranges move very aggressively as global assets and domestic assets wax and wane from a return and risk perspective, and you need to be very active around that 35 to 40% range, whatever you select. So from our perspective, it's not true that you max out at 45% global assets and stick to that level. You need to be active in terms of that asset allocation. So as I finish off the presentation, I just want to talk about some of the more qualitative aspects. How do you execute effectively on a global strategy? I'm going to talk about the process effectively, the Sentio process, in terms of how we manage global assets. And then I'll talk about how we structured the business effectively. So at the outset, active asset allocation, and I've specified and I've stressed this on numerous occasions. You have large periods when SA assets outperform long periods, and sometimes the extents can be very high as well. And similarly, global assets outperforming for long periods, and the extents can be very high as well. So active asset allocation is very, very important to actually get the best bang for buck from your global strategy effectively. And you need to have an active strategy between bringing assets offshore, taking assets offshore, and bringing them back based on your valuation and your investment process effectively. Managing the currency risk is very important for global bonds, in particular, especially during periods when the rand strengthens. We've emphasized that to get the best bang for buck from your global bond assets and your global cash assets, you need to actually make sure that you've got an effective currency hedging strategy as well. And this applies to an extent to global equity as well. When the rand has weakened a lot, the rand typically takes the elevator up and the escalator down. We're currently maybe taking the elevator up now. When you reach a certain level, you want to start hedging the global equity exposure as well for the periods when the rand starts to strengthen as well. So global currency hedging is very important as well. And then your global equity portfolio to get your best bang for buck, because South Africa is a very commodity-centric value kind of market from a global perspective. You want to emphasize quality in your portfolio. You want to emphasize sectors that have less correlation with SA mining and SA value exposure. So global staples, global tech, global consumer discretionary names as well. But I want to emphasize it doesn't mean that we don't invest in global emerging markets or global energy stocks. All we're saying is that the bar for investing in those stocks is higher. You need a higher expected return in those sectors, in your global sectors, before you invest in them. Or alternatively, the weighting that we apply in our global portfolios for those sectors that we're also getting in South Africa will be slightly lower. So, I mean, because you can get Sasol in South Africa, you need to compare Sasol versus your global energy names effectively. So it doesn't mean we don't invest in the global energy names or the global mining names or global EM names. Just the bias is a little bit higher. There's a bias towards quality effectively in our portfolio. So putting this all together, we don't think you can effectively allocate or manage a global balance fund in South Africa purely with an asset strategy and outsourcing that to a global manager. You need to do that on a very, very integrated kind of basis. So how do you structure a business to effectively deliver, final slide from our side, to deliver on the objectives? And a lot of asset managers focus a lot on the process. They're wonderful investment guys, but the asset management structure, the business isn't effectively structured to deliver on those objectives on that integrated process effectively. So you need, from our perspective, you need to be managing domestic and global assets in tandem in the same company effectively. And that's what we do at Sentio effectively. You need an effective integrated team to actually deliver on this integrated strategy, which means a multidisciplinary investment process. You need a very good domestic equity team. You need a very good global equity team. Similarly, on the fixed income side, a good domestic team and a good global team. And you need a proper asset allocation process to put all of that together. And we've spent a lot of time at Sentio over the last, we're around for 15 years now. Some of you might find that difficult to sort of believe, but we are, and we've been managing global assets directly for the last 7.5 years. So we've got a process that effectively does all of this, and we've got teams that effectively do this in a very nice integrated kind of fashion. And finally, you need, in a world of extreme amounts of information and data, you need a very effective data and machine learning architecture, which creates the ability to scale up your investment process in your investment team to actually effectively manage global portfolios. I mean, 4 to 6 people, can manage a global portfolio effectively, and global guys actually do that very effectively. We think South African managers are very spoiled, and we think sometimes South African clients also are misled into believing that you need 40 people investment team personnel to manage global portfolios. You don't need that. If you're using an effective data architecture, effective machine learning architecture, you can actually work with fairly good, decent sized teams, 4 and 6 size teams. So you can have a very nimble investment team at the same time, and your machine learning creates very unbiased portfolios as well. So Sentio is structured around these important building blocks effectively. And finally, your portfolio construction engine is very important to actually create robust portfolios. Again, just to remind you, Sentio is all about risk-adjusted returns. We don't want to shoot the lights out in a particular year and then disappoint investors with terrible returns the next year or two. We're all about stability and all about consistency of returns, and that's what we're trying to achieve within the house. And the final slide, can we demonstrate this? And we believe we can. This is our Sentio Global Balance Fund that we've been running since the end of 2017. And what you can see on the left-hand side is our asset allocation, our actual asset allocation at Sentio going historically. You can see we've been very active in terms of our asset allocation. And on the right-hand side, we've added value relative to our strategic benchmark that we've discussed earlier. This is in our red, this is your total value add in the fund versus the strategic benchmark. Your blue line is your asset allocation value add. So the difference between the two is your stock selection value add. So we've added value on asset allocation and stock picking as well. And if you just strip out just purely the global components, global equity and global bonds, the allocation from that pure effect, so not the stock selection effect, just the allocation effect, that's also added value. So we've got a good asset allocation process and stock picking process, both global and domestic, and we can demonstrate that that value add has been achieved. We don't always get things always right. We do get things wrong, like any other asset manager, but we do have that ability to over time, get our calls right on average, and we have demonstrated that. So I think I'm just going to end on that and leave it over to questions. Ending off there, then those are our retail products and the platforms that our retail products are available on. There's one more fund that we're launching in the next few months, is a domestic flexible bond fund, and that's coming up as well to complete our range of products that we've got in the retail space. Thank you for your time, and leave it over to questions.
Thank you very much, Ray. Yes, there have been a few questions from in the chat from the audience. The first, and it goes back to right at the first few slides which you were showing. There was a question saying the asset property had the same or lower R square to local equity, which then changed suddenly in 2018. Why couldn't the same occur to global bonds? And also in the same similar kind of vein, maybe a comment about gold, because obviously over much longer investment horizons, it has proved to have a strong, less correlated effect with risk assets.
Okay, excellent question. So the issue around global bonds really revolves around our inflation view, or the effectively what happens to inflation. You are 100% correct. Over this investment period, you've had an extended period, especially the last 25 years, where global inflation has been declining, and global bonds, as a result of that, has been behaving as a risk-off asset. In other words, uncorrelated. And I'm talking about dollars now, global bonds in dollars versus global equity in dollars, and I'll bring that down into current rand terms effectively now. And you've had this debate around whether the 60 portfolio is relevant in a period where inflation is rising and global bonds now become positively correlated with global equities, like we've seen in the start of this year. Our take on that is that we think for a short period of time, global bonds are going to be positively correlated with global equities, and global bonds are going to sell off together with global equities, purely because we've seen clearly a Fed policy area in the last year. They should have been hiking rates last year, and even if you go back maybe a year before that, they shouldn't have stimulated as much as they did, given what fiscal stimulus was doing during that COVID period and the lockdown period. So there was clearly a policy area from a Fed perspective. They let inflation get out of control, and as a result of that, they need to hike interest rates urgently this year. and quell inflation out of the system, which means that there's an elevated risk of recession. Our view is that we are going to get a global recession. We've taken a very dim view on risk assets as a result of that. We're very underweight risk assets and taken a very conservative position. But we do believe that central banks are taking the inflation threat seriously, especially the Fed. Europe, we've got to talk about separately. If you want to ask about that, they've got serious issues, which is very different to what the Fed is dealing with. But we think the Fed is going to take the inflation fight very seriously. We think they're going to hike and get inflation out of the system. And at some stage, that bond equity correlation will restore itself, i.e., the negative correlation between bonds and equity. Maybe not this year, maybe not next year, but at some stage, it's going to restore itself, which means that bonds are still going to be then negatively correlated with equity in the long run. And as a result of that, you're going to get still the diversification benefits from bonds. In the short term, we have taken a view that bonds are probably going to be positively correlated with equity. So we've underweighted global bonds in our global portfolio. So the strategic asset allocation does have 15% global bonds in there, but we're running a very underweight position because of that 1 year, 2 year view of Fed hikes and the Fed trying to get its credibility back in fighting inflation out of the system. So for that period, we tactically underweight global bonds, but we do think longer term that correlation will be restored and you'll get those benefits from global bonds. Just bringing the currency into account. So even the global bonds might sell off relative to global equity, we think the currency benefits will still be there. We think that during a period where the Fed is hiking a lot, inflation is being driven out of the system, and you've got a global recession potentially, or almost certainly in our case, the rand is going to weaken during that period, and we're starting to see that right now. So you're still going to get the benefits in rands from global bonds as well. Whereas in SA property, you didn't get that because SA property pretty much is a rand asset effectively. So we think you are probably going to see a rise in this correlation, or the explanatory the percent explained of global bonds versus SA equity, but nowhere to the extent relative to what we've seen in SA property. So the second question was, hope I've answered
gold.
the question.
Just the word on gold.
Was gold. So gold has been a very patchy asset. So in an environment where the Fed is fighting inflation and there is some credibility to central banks, and we think that even though central banks have lost a lot of credibility, there is still enough credibility in the system. Gold will still probably not be the most effective hedge against drawdown. So if you look at that drawdown chart that I plotted over here, gold comes somewhere in the middle. It worked very well during the 70s and the 80s when central bank credibility was completely shot. So gold is more of a hedge against central bank credibility than inflation, is what we're saying. But in an environment now where inflation is rising, but there is still some central bank credibility, gold is a bit of a patchy asset. So you're seeing gold prices come under pressure every time there's a threat that the Fed's going to hike a little bit more, and we think that's purely because there is still some credibility around the Fed effectively. So hence we think gold will be a patchy asset from a hedging perspective, and we think there's going to be still some correlation of gold prices to the global commodity cycle. It's not going to decouple completely and become a pure risk asset. You want to buy gold when commodity prices are strong and the dollar is weak. And you want to buy gold when the Fed's cutting interest rates, when the cost of carry of gold is actually declining, and that's when you want to buy gold, not as an inflation hedge, not as a purely because the credibility of central banks are still pretty much intact, and that's our view.
Thanks, Ray. I have a few more questions. The one is the 1971-1979 period, the oil crisis and hyperinflationary situations. Should the exposure to equity funds be higher than 35%, and what exposure to bond funds?
So during that period, interestingly, I mean, if you just look at the optimal allocation during that period, equity allocations were very high. So you'll pick it up in the rolling analysis that we did here, that rolling 20 analysis. The end of that period was 1989. So we just look at it over here. You can see that the SA equity, which is the bottom one, was pretty high, close to that 30% mark. During that period of high inflation, the 70s and the 80s, SA equity was a pretty good asset to be in. In fact, foreign equity as well, global equity as well, was a pretty good asset to be in. Global bonds, performed pretty poor during that period, and SA bonds weren't that great. But SA bonds, remember, you need to take that period of 1958 to 1989 where we were in prescribed assets. So global SA bonds weren't really a proper tradable assets. What you could say is SA bond yields were actually artificially low during that period. So during that 70s, 80s period, you did see an elevated a period where actually equity allocations were higher than bond allocations, to answer that question. But we don't think that's going to be the case going forward, because central banks made a clear policy error during that period in terms of hiking too late. The Fed started hiking in the early 70s, pulled back. So inflation actually went up. If you recall, just look at the numbers. Inflation went from, looking at the early 70s, went from about 2% up to about 6%. The Fed stopped hiking. Inflation came down to about 2% and then shot up back to about 10% again in the mid 70s, and then came down again, and the Fed stopped hiking and then started to rise again during the second oil crisis, which was 1978, and then inflation peaked at about 40% when Paul Volcker said, that's it, we are hiking rates, putting real rates up and permanently till we see inflation actually decline. And they really quelled inflation out of the system, which by the early 80s was called out of the system. We don't think we're going to see that stop-go kind of period as we saw in the 70s. We think the Fed is going to do what is necessary to quell inflation out of the system before they pause with rate hikes. And as a result of that, we think bonds could do okay during the cycle. So we think you need a balanced exposure this time between global equity and global bonds, not like you saw in the 70s bias towards equity over bonds during this period. And incidentally, during that period also, you had a clear bias towards commodities as well. Whereas in this period, if you're having a global recession and if the Fed is comfortable to have a high unemployment rate in the US, which we think they have to, probably global commodities are going to do badly during this period. So we think this period of high inflation is going to be different to what we saw in the 70s and the early 80s.
Thank you very much, Ray. There are two more questions, and I think we will then leave it at that, given time. But if there are any further questions outside that afterwards, please feel free to send it through to us either on info@sentio-capital.com or tc@sentio-capital.com. The final two questions are one word on global risk, mostly coming through the currency, and which is most likely commodity linked. Is that a statement you would subscribe to?
Yeah, to some extent, I would say that. So I think it's probably a period of commodity prices being stronger, which obviously means that the risk of global equity is the rand strengthening. You don't mind the rand weakening when you take your assets offshore. It's when the rand strengthens. So to some extent, it's global commodity prices. That's when our currency is typically fairly strong, because that's at the time when the dollar's particularly weak and all emerging market currencies are strong. But it's also periods, I mentioned it in joking fashion, the rand takes the elevator up and then it takes the escalator down. So once you've taken that elevator up during periods of risk off, that immediately becomes your risk for global assets now, because your rand's going to slowly grind its way down over a 1, 2, 3 year period. So that's what we mean by the escalated down. It takes 3 or 4 years before the rand actually strengthens to the level that at which it started its first weakening effectively. And during those periods of risk on environments or more moderate risk environments post the crash, effectively is your biggest risk for global assets, and that's when you want to hedge your global assets effectively.
Thank you. And then the last question coming through in the last slide, where you showed the proof of concept, or the proof in the pudding, basically, is in the asset allocation effect, is the South African asset allocation also value add?
Very much so. So I mean, we haven't mentioned that, but I mean, to actively allocate between SA equity and SA bonds, I mean, we split out the asset allocation effect and split out the domestic versus global in the last slide that we had, which I'll just jump through. I mean, we've added value, significant value in there as well. So I mean, if you just look at that gap now in terms of the red line I'm plotting, that's your asset allocation value add between domestic bonds and SA equity and SA bonds, inflation-linked bonds included in there, and cash as well. So it's very important to asset allocate within SA assets as well. There's significant value add in there, and hence you need a process. You need to manage a good balanced fund. It's extremely difficult. You need a great SA equity team, a great SA bond team, great global team, great global bond team, and a good asset allocation process. And if you don't have all of those processes sound, you're not going to do a great job at global asset allocation. It's extremely tough. Tough fund to manage. You really need strong teams, a very strong process, and a strong structure, like I've emphasized, to deliver on the alpha that you can deliver in a global balance fund. But when you actually do it correctly and you do it well, the returns and the rewards to your clients can be very rewarding.
Thank you very much, Ray. Thank you very much, everybody, for taking time out of your busy schedules. There will be, the slides will be sent to you following this presentation. There will also be the recording available on our YouTube channel. And if you have, as I mentioned, any further questions with regards to the topic, please feel free to engage with us. Thank you very much again, everybody, and have a good day.
Thank you, guys. Thanks a lot.